Looks like we have everyone here. A little background here. Good morning, Member Rosen and Member Ardinger.
Good morning.
Morning.
Member Rosen certainly knows how to make an entrance with his own theme music and all. That's awesome.
Was that me?
I'm just kidding.
I had no idea. I've never heard that before.
Okay, well, it's we will call the open session meeting to order. Good morning. My name is John Von Paris, and I am serving as the chairman for the MDTA Finance Committee meeting this morning. I hereby call the meeting of the Finance Committee to order at 9 a.m. Due to the COVID-19 pandemic and in accordance with the live streaming law, this meeting is being conducted via video conference and being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. I ask that anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line, please mute your phones except when speaking. There are no members of the public, no elected officials, and no members of the media pre-registered to speak at today's meeting. At this time, we will move on to agenda item number 1. Number 1, we're seeking approval of the March 9th, 2021 open meeting minutes. We have the motion to approve the minutes.
So moved.
As presented.
Second.
We have a motion from Member Rosen, second by Member Carroll. Any further discussion? If not, all in favor?
Aye.
Aye.
Okay, it's unanimous. The minutes are approved. We will move on to the second item, the third item on the agenda, and item number 2, the investment committee report quarterly update on the investment of MDTA's funds, and Alan Garman will lead that discussion. Good morning, Alan.
Good morning, thank you. This morning with me presenting are Danton Ponzel of PFM and also Clayton Vwig of MDTA. This is our normally scheduled quarterly review of total return performance for our portfolio. It will be the trailing 12 months through March. And to start it off, we generally discuss briefly the implications of the market on the portfolio and what we're seeing. So I'll turn it over. I believe Danton is on the line. He can discuss slides 2 and 3.
Perfect. Thanks, Alan. So I'll cover a quick brief market update, and then I'll turn it back over to Alan to talk about the portfolio. During the first quarter, economic conditions were characterized by dramatically lower COVID-19 caseload as vaccine inoculations ramped up despite initial logistical challenges. In addition, improving economic data was supported by an additional $1.9 trillion in relief funds from the American Rescue Act. This positive economic growth during the quarter, paired with positive vaccine headlines and large amounts of stimulus dollars being injected into the economy, led to positive economic growth expectations, and in turn, a significant rise in longer-term yields. The U.S. Treasury yield curve steepened dramatically during the quarter. Yields on short-term maturities under a year remained range-bound and anchored to the Fed's near-zero rate interest rate policy, and the 2-year Treasury was held flat at 20 basis points during the quarter. On the longer end of the curve, and if you can see the materials, there's a chart in the top left-hand corner. You can see how the 5-year tenor and the 10-year tenor increased dramatically during the quarter, with significant pickups as a result of the economic growth projections. In the final revision, U.S. GDP growth posted 4.3% 4.3% expansion in the fourth quarter of 2020. And the first estimate, according to the U.S. Bureau of Economic Analysis, first quarter GDP came in at 6.4%. So significant growth that we're seeing in the economy as things begin to return to normal. We're also seeing strong growth that is expected in the second and third quarter. Jumping onto the next page, which covers the labor market, we saw progressive improvement over the quarter. The unemployment rate ended the quarter at 6%, down from 6.7% as of December 2020. Non-farm payroll shows strong and accelerating improvement, adding 916,000 jobs in March. And initial jobless claims, even though they remain elevated, we saw weekly claims drop below 700,000 for the first time since the beginning of the pandemic. We're seeing considerable improvement from the high of 14.8% in unemployment at the beginning of the pandemic, but there's still some ways to go to get back down to that 3.5% we saw at the end of 2019, early 2020. In fact, as of March 2021, there's a 8.4 million gap in total non-farm payroll jobs from the beginning of the pandemic. Turning over to the Fed spent much of the first quarter continuing to convey its commitment to the full scope of the monetary authority to facilitate economic recovery. As a result, they made no change to their near zero interest rate policy, holding that at 0 to 25 basis points over the quarter. According to the Fed dot plot, the Federal Reserve anticipates near zero rates through 2023. They have continued their monthly asset purchase program, purchasing $80 billion in U.S. Treasuries and $40 billion mortgage-backed securities to further substantiate progress towards their goals of maximum employment and price stability. And just taking a quick look at price stability, we can see how the Fed has shifted their framework for evaluating inflation. Previously, they're holding a threshold of 2% as their target for inflation, but most recently they've shifted towards an average inflation target. So we should expect to see inflation run hot above 2% in order to achieve that 2% mandate before the Fed decides to make any changes with interest rates. And I'll turn it back over to you, Alan.
Great, thank you. I think Clayton is going to cover slide number 4.
Thank you, Alan. This is Clayton Viewig, MDTA. As you can see on slide 4, we demonstrate a breakdown of the portfolio of the assets of the agency. This includes all assets, both match funding and total return portfolios. And we'll dive into this a little bit deeper later on in the presentation. As you can see, we're significantly weighted to very high quality government-related securities in the Treasury and agency space. On the top right, you'll see the portfolio activity for the trailing 12 months. TTM is trailing 12 months, and that's consistent with what's occurred in the past. This activity tends to increase with issuance of bonds, which we experienced in April. And so I would expect to see these numbers go up in the next report. Down at the bottom, you'll see some activity for the portfolio as well, where we had maturities of commercial paper during the quarter. And then also on the bottom right, the asset allocation for the period ending December 20 and as well as March 21 with the changes. Alan, I will turn it over to you for the strategy discussion on slide 5.
Okay, thank you. On slide 5, we have a chart at the top of the page that shows the strategies employed for the previous quarter and also the current quarter. We've had no changes in strategy for these 2 quarters. The general account remains benchmarked against a 1 to 5 year index. So we essentially have investment maturities staggered from 1 to 5 years. And the M&O reserve, as you may recall, is in transition, and it's being extended from that same 1 to 5 year benchmark out to a longer term benchmark. We've been taking a bit of a slow approach to that transition because rates have been rising so quickly, and trying to avoid some of the negative price changes, but it is the intention, and we continue to advocate for that longer term strategy. We expect it will outperform the shorter benchmark over multi-year periods. So those top two accounts are our total return monies that we don't need to draw on. Those are just long-term reserves where we can take a bit more interest rate risk and continue to focus on, higher average multi-year returns. For the capital account, that account is considered matched funding. So as always, we match investment maturities to the expected cash flows. So everything in that account would mature and before we expect to make that spending. In the month of April, we had our bond proceeds settle. You don't see that yet on this chart because this is only through March. But the construction money from bond proceeds is the same as capital money. The investment maturities are matched to proceed or coincide with the expected spending. In terms of debt service reserves, all of our reserves, other than one, are backed by surety policies, so we don't have cash funding in them. The one policy that we do have cash funding, we anticipate converting that over to a surety policy this month. So we've been holding those investments with overnight liquidity. And once we make that purchase, the cash of approximately $30 million will move from that account into our capital account and be available for construction. Moving to slide 6, we've gone into some detail in past meetings, but it gives you a sense of the multi-year perspective on total return performance. And I just highlight that in some prior years, back in 2012 through 2018, you can see on the price return line, you have negative returns there in red. And that was a period when interest rates were rising. So when you add essentially your weighted average coupon or your income component of your portfolio to the price returns, you get a total return. And then you can see in the 2019 and 2020 periods, you had these enormous price returns as interest rates fell. And so you have very above average or above normal returns on the portfolio in those years. And now in 21, you'll see in our performance slides that are coming up that as interest rates have started to move upward sharply, that price return component is negative again. And so it remains to be seen for the year, how much negative we'll get from the price component, and will that be offset by the income. But I think the focus for the total return portfolios is that we're maintaining relatively constant durations in the general account. We're converting over in the M&O reserve. But the view is toward multi-year returns. So we're less concerned about short-term volatility, and we're more focused on achieving higher average returns over multi-year periods. I think that takes us to slide 7, Clayton.
Thank you, Alan. So again, on 7, you'll see the recent negative performance in the portfolio. This is the general account through March. And especially in February with the spike in rates, we had a tough month. But over the trailing 12 months, as you can see on slide 8, we're positive, and the portfolio has outperformed the benchmark there at the top, trailing 12 months, where the portfolio has done 88 basis points and the benchmark has done 62 basis points. Also, as Alan has just mentioned, the primary goal here is to match the duration of the benchmark, and you can see that over to the right of this slide 8, where the portfolio is consistently, high 90s to low 100s percent in terms of its positioning relative to the benchmark. Ideally, you want to be at 100 all the time, but there is some change in market values of the portfolio relative to the benchmark because within this general account, we do hold securities other than agencies. Are there any questions so far? No? Okay, moving on to slide 9. This is somewhat the same story. What we see in the blue is the performance of the portfolio, the M&O account, for the trailing 12 months. And in the orange or yellow, we see the performance of the current benchmark. As Alan mentioned, we moved to a longer duration benchmark. This was approved by your committee and the board in, I guess it was November. And so we started transitioning this portfolio in December. And so this is the performance of the new benchmark, which has struggled with the volatility of interest rates. It's been to our advantage, the agency's advantage, to hold off on transitioning during this period. And so we also show the performance of the former benchmark or the agency benchmark in the red. Following on slide 10, we see the account value just over $50 million for the M&O account. So just to reiterate, the general account benchmark is a shorter duration benchmark at just under 3 years. The new benchmark for the M&O account is now about 7 years. In fact, you can see that on this table down in the bottom right under target, where we have a benchmark duration of 7 years, and the portfolio has been transitioning with a benchmark of just about 3 years. And again, trailing 12-month performance for the portfolio was positive. You know, we are sensitive to month-to-month performance, but our focus, as Alan said, is definitely long-term performance and our expectation that a longer duration portfolio should outperform. On slide 11, we move to the maturity distribution of the portfolio of the assets of the agency. As you can see on the right side, at the end of March, the total assets were $584.2 million, heavily skewed to the shorter maturity securities, the 0 to 1 year bucket. And the change in that 0 to 1 year bucket has been affected by the spend for construction. What we've decided or discussed in the last investment committee is also providing a breakdown for the longer term portfolios, slide 12, given that they're focused on total return and not a match funding basis. So we provide at the top the maturity distribution for the general account. We also provide down below the maturity distribution for the M&O account. So where we've transitioned from a shorter duration 3-year benchmark into a longer duration 7-year benchmark for the M&O, you'll see that we have maturities out in the 5 to 10 year bucket there on the bottom right in the maturity distribution M&O table. Another way to look at this, it might be best to skip to slide 15, if I may. So slide 15 there at the bottom, you'll see that the total assets of the agency are 584. That ties to all the other tables and charts that we've shown thus far. And we have longer term assets, the general account, the second item, and the third account, the M&O, which are just over $350 million, which tie back to the prior slide 12. Those are where we're focused on duration or total return. All of the other assets are basically match funding or debt service reserve that we have very short maturities with. Alan, would you like to add anything? Okay, I will proceed. Can everyone hear
Alan,
me?
I have to unmute. You're muted. There we go.
Yeah, I think our focus is always on maximizing returns for every account. We're very much tied by whatever prevailing interest rates are, and for the very short matched funding accounts, I mean, we're looking at money market yields that are effectively around 1 basis point, 1 to 4 basis points, and except for our debt service accounts and the construction accounts, we're able to buy a bit of CP and some short agencies that are out a few months, but you're going to see in the next year very low returns for those portfolios as well as the total return portfolios because just prevailing rates are extremely low. And I think you saw that in the first couple of our slide too as well.
Absolutely, and we made note of that there on the second bullet of slide 2, how money market mutual fund and MLGIP rates are below 5 basis points. We've actually, as we look for opportunities and find them, have actually been able to do, in some cases, 2 or 3 times that, 10 or 15 basis points. So we say 2 or 3 times, that sounds fantastic, but prevailing yields are still quite low. And it's a tough hunt, to be honest. But we are seeing some opportunities. So maybe moving back to slide 13, where we have the first page of the compliance report. You'll note there in the top section we show the longest maturity for those accounts. And we, with having done our compliance check, we know that we are in compliance. So there is nothing to report there. I would say that last line, you'll see again reference to the unrestricted M&O, longest maturity of 7 years. We can go out to 15 years. Thus far, we have not done so, but we are in compliance. Moving down to the second section, we begin to show the sector breakdown and the issuer breakdown for these portfolios. And just to reiterate, over on the far right, you'll see that we've done our compliance check and we're within compliance for all issuers and sectors. On slide 14, we see the same over on the far right. With our compliance check, we note that we are in compliance, and we also make that statement confirming such down at the very bottom of that slide. I would also say, again, you'll see at the very bottom near the middle, we just tie out to that $584.2 million. So that's what we're always looking to make sure we tie out to. With that, and no questions, I will turn it over to Alan.
The last few slides we have are for informational purposes, and happy to cover any of those slides if there are questions or any other questions.
Yeah, Alan, one quick question. When we made the decision to change the duration, pre-pandemic, and then we put a pause on it, probably rightly so, because of the great unknown. And then we shifted course. We decided to proceed and shift the duration. I guess my question is, and I know some of this has to do with when you're finding opportunities to invest appropriately, as was mentioned. How quickly should we be headed toward this new duration target, given what seems to be an odd market at best, where you have the Fed indicating they're going to keep rates low versus there seems to be inklings of inflation out there that is disconnected with fiscal policy?
Yeah, I think, we've been looking for some opportunities, with new money taxable muni bond issuance where we're able to pick up some yield. And then, some weeks, you're not getting that much spread, so there's been less opportunity. We always have the opportunity to essentially sell a big portion of the portfolio and extend out, within a day. We've been hoping to see some signs of stabilization in the market, as a bit of a signal to go ahead and start more aggressively moving to the transition. And I think we're starting to see that, in the month of April, where the market took a pause from rising rates, and it's making us feel a little more comfortable to start moving, farther out the curve. So I think you'll see us in the next quarter when we come back, we'll have transitioned more of the portfolio by that time. And, hopefully a lot more people will be inoculated and we'll see some normalization in employment, with more people returning to work and businesses hiring again. I think in the next item, you're going to hear a little bit about things returning or normalizing in the airport sector. And I think all of those components of the economy give the Fed a little clearer picture on what to do. And so, that's another element out there, is that, when the Fed communicates that it's going to continue buying treasuries to hold down long-term rates and mortgage-backed securities, that's comforting to us. But if they start, making noise about slowing those purchases, then I think it will be a signal for the market that accommodation is not there and that rates may trend higher. So we're looking and waiting and watching and slowly transitioning. So is there a sense from, I guess, the Finance Committee that you will have some, concerns that we're not moving quickly enough, or concerns that we're moving too quickly with that transition?
I don't have a concern. I think you basically answered the question, that you're looking at it with the general understanding of what's happening in the more macro environment. And I think that's great. I mean, you're looking at stabilization. I think that's fair. And so I don't have it. No, I wouldn't characterize it as a concern, more so than just asking the question, given the many unknowns. And obviously what's going on in the world is destabilizing equity markets, but it sounds like that's counter to what's happening on the bond side at the moment.
And Member Rosen, during our internal investment committees, this past one that we had similar conversations that you're raising, where we're talking about, whether at what point in time, and we're all supportive of the strategy that Alan has been executing and being really slow with this. But part of our conversation has also been that we're going to revisit this. And if for some reason now isn't the time to extend out, we've asked ourselves, should we come back to the Finance Committee and have a conversation about the duration and benchmark and actually change it? We're not to that place at this time, because right now we have an approved strategy that informally we're choosing not to follow. We're choosing to lag behind. And at some point in time, we need to align what's officially been approved by the Finance Committee with our actions. So, we're having similar conversations that you've raised, and it's something that, we've said that we're going to continue to look at in the next couple investment committees, which means we come back to you in another quarter.
Thank you.
Great. I think that concludes the investment report for the quarter.
Okay, thank you very much, Alan. Deb, I have one question on the alignment. When you just mentioned an alignment, when would we seek to get more aligned with the policy?
I think so what I mean by that is, we extended the benchmark, right? We have a longer benchmark, but we haven't invested out as far as what the benchmark allows us to do so. And that's been a conversation that Alan and the group and the finance committee has had together. That's what I mean by not being in perfect alignment with that benchmark. And so we come back to you in a quarter, and when we come back to you, we'll either you'll see us where we've started to move out, or we will be having a conversation about why we think we should stay right where we are, or if we need to consider changing anything. And if we feel like we need to make a recommendation to change something, we'll of course support that rationale for you. So my point wasn't to say that I'm concerned about what we're doing. I think it aligns with our conversations. My point was more that the question that Member Rosen asked is the same type of conversations we're having as staff at our internal investment committee meetings.
Okay, thank you. Are there any other questions on this topic? Okay, if not, we will move on. Alan, you're still up to agenda item number 3, update on non-recourse financing and loans.
Great,
You're up,
thank
Alan.
you.
Thank you.
I have Dana Tate with me as well, and Jim Walsh of MAA will be presenting. This is a periodic update. We've had quite a lot of activity with our non-recourse financings, and we thought it was appropriate to come back with another update. We've had 2 bond defeasances, and then as you've heard in recent months, there are quite a few pandemic-related impacts on airport revenues. So that's the purpose of this item. So we want to discuss the explanation of the pledged revenues, the flow of funds, and these trust-specific reserves. As a conduit issuer, the MDTA has financed non-recourse debt for the Maryland Aviation Administration to finance various projects. We've also done financing for WMATA, for parking garages in PG County. We don't have an update on the Calvert Street garage, but we'd also financed that, and it's a state employee parking garage in Annapolis, but there's no new news there. The 3 airport-related trusts have unique pledged revenue categories. So we have passenger facility charge-backed bonds. So those are an enplanement fee for each passenger that boards an airplane. So those revenues are pledged to those bonds under a separate trust agreement. So I just want to highlight that these trust agreements do not pledge the toll revenues of the MDTA. They're completely separate trusts. Also, MDOT's revenues are not pledged under these trusts. The other 2 financings at BWI were for a consolidated rental car facility, and that particular trust is backed by rental car fees. And then the last one was for parking facilities at the airport, and that's one of the bond issues that's been recently defeased. The table on the top of that first page highlights the 2 remaining financings at BWI. The first one is the PFCs. The debt service for fiscal 21 is about $25 million. And in terms of the flow of funds, the revenues flow into a revenue account, and the trustee bank sets aside 1/12 of annual principal and interest in a bond service account. And then everything left over flows to an improvement account. And so those monies remain in the trust, and they help to secure the bonds. So currently in the improvement account, the balance in that improvement account is about a 1.5 years worth of debt service. So that's quite a large reserve that we can tap in the event that revenues are not sufficient to cover debt service. And in addition to that improvement account, there's a debt service reserve that's funded at maximum annual debt service. So essentially you have a full 1 times coverage. So just to put it in perspective is that if you had 0 airport revenues from enplanements, you'd have essentially 2.5 times your annual debt service. So you could go essentially 2.5 years with no revenues and still be able to cover debt service. And the same is true for the rental car facility. There's an improvement account and there's a debt service reserve. And we also have a small additional coverage reserve that's currently equal to about 15% of maximum annual debt service. So with that, I will turn it over to Dana to give you a few more specifics on those 2 financings, the PFCs and the rental car facility.
Okay. With regard to the PFCs, the pledge revenues for these bonds are derived from a charge of $4.50 for every enplaned passenger. We have seen a shortfall in the PFC revenues due to the pandemic for fiscal year 2021 through April. Revenue collections stand at $16.3 million versus $39 million at the beginning of the shutdown last year during fiscal 2020. Our trust agreement allows us to utilize the PFC Facilities Improvement Fund, which is pledged to bondholders should there be a shortfall in revenues to fund the bond service account. There are also ample funds in the Debt Service Reserve Fund. So far, we've transferred from the Improvement Fund a total of $4.6 million over a 9-month period for the fiscal year, which represents on average around 20% of the revenue shortfall to cover the debt service set aside. The shortfall in revenues did impact the debt service coverage, which is estimated to be an average of 80%. However, there were no transfers needed from the Facilities Improvement Fund over the past few months due to a sharp uptick in revenues as passenger flights have been recovering steadily. Revenue collections have increased from $783,000 in January to $3.4 million in April. So based on this uptick in revenues, we estimate that our debt service coverage will be closer to 100% by the end of the fiscal year. With regard to the CFCs, or the rental car facility bonds, the pledge revenues are derived from a fee of $3.75 per day per rental car transaction. Due to the pandemic, CFC revenues for fiscal 2021 up to February were $3.2 million, or 190,000 rental car transactions. And for the full fiscal year of 2020, we saw rental car transactions of 595,000, and revenues were $8.9 million. We are projecting CFC revenues to be around $4.9 million by the end of this fiscal year. Now, due to this shortfall in revenues, as needed, we've utilized the Rental Car Facility Improvement Fund as permitted by its trust agreement to make up for the shortfalls and fund the bond service account. There are also ample funds in the Debt Service Reserve Fund. We transferred a total of $2.4 million over a 7-month period, which averages about 40% of the monthly set aside. We estimate, based on revenues, that our fiscal year 2021 debt service coverage will come in below 1 times, and the rate covenant requirement is 1.25 times. The MDTA is embarking on a $6 million advance transfer from the Rental Car Facility Improvement Fund into the bond fund to boost coverage above 1.25 times. In fiscal 2020, the coverage was 1.39 times. We hope to see some more improvement in rental transactions. And all in all, we have been working with MEA to ensure that we boost coverage for our PFC and rental car facility bonds in line with the trust agreements and rate covenant requirements. I will now turn it back over to Alan.
I'll I guess pause here for some questions, and also I'd like Jim to interject, but I just wanted to point out is that, we've had a lot of conversations with MAA and our bond counsel and advisors on these financings. We've been in constant communication with rating agencies on updates, and we've got a lot of tools and reserves to tap to keep the rating agencies comfortable and bondholders comfortable. And so, when you read into these trust agreements, it's important to note that these improvement accounts are pledged. That's what they're there to act as, is like a fallback option. And so by proactively moving the $6 million for the CFC bonds into the coverage account or the debt service account, we can boost debt service coverage this fiscal year, so we can keep healthy coverage, keep the rating agencies and bondholders from being concerned, and just reassure everyone that we have ample cash, to meet debt service this year and next year if, revenues are diminished. So Jim, can you interject a bit with some thoughts?
Yes, Alan, thank you. And let me just say to the members, thank you to Deb and Alan and team. It really is an excellent collaboration between aviation and the authority. So thanks very much for that. Real quick, we think we're pretty well positioned going forward. Our recovery in terms of passenger traffic has been more robust than forecast. Over this weekend, we were at 70% of pre-COVID levels. Last month, we opened our long-term A lot 6 months ahead of schedule. And next month, we're opening our long-term B parking lot 1 year ahead of schedule. So all this is good news. As Alan and Dana said, we do have a coverage target of 1.25 for the consolidated rental car facility debt. And we think it's prudent, underscore prudent, to move those funds to meet and exceed coverage for a couple of reasons. One is in July, we're going back out into the market with our new revenue bond structure with MDOT for a new money issuance of $250 million to fund a terminal expansion project. And we'd like to signal to investors and rating agencies that we are being prudent and responsible in meeting and exceeding coverage. I'll just add this on the PFCs. Although there is no rate covenant for PFCs, we have an internal policy to have at least a 1.5 coverage. How do we achieve that with these under collections due to the pandemic? Well, we're going to be using federal funding. That's our plan. There's a couple of boxes we have to check with the FAA, but with CARES 2/CRISA, we just got a grant offer for $20 million from the FAA, and we're intending to use that to pay back MDOT with PFC PAYGO for funding they loaned us for our Terminal E expansion several years ago. That will boost coverage. In addition, on the PFC side, in addition, the American Rescue Plan, we're looking at roughly $100 million, which we intend to use again to pay back MDOT with PFC PAYGO for the Terminal E extension. And that too will boost PFC coverage far above our 1.5 target. So things are looking certainly more positive than they were 6 months ago. We're pleased to report. And with that, I remain available to the board for any questions.
Any questions?
If there are no questions, I'll move on to the last two financings. For the BWI parking bonds, those bonds were paid off, effectively legally defeased in February. So MDOT issued bonds under a new indenture. It's a general airport revenue bond indenture. So there's a new trust agreement that's separately secured, and a portion of the proceeds of that financing were used to pay off the bonds that were issued by the MDTA. So once those bonds are legally defeased, that debt no longer shows up on our balance sheet. And we also had a lease payment receivable that's also removed from our balance sheet. And I'm going to go into a little bit more detail under the WMATA section with the mechanics of the legal defeasance. In the case of both the BWI parking bonds and the WMATA parking bonds, the bonds are not yet callable. So what occurs is we take bond proceeds or cash and deposit them in an escrow account with the trustee bank. So that's an irrevocable deposit of monies. And with that cash, we turn around and buy treasury securities. So those are permissible investments in an escrow account that don't have any credit risk in theory. And then those investments are matched to the upcoming debt service. So because the big bonds are legally defeased, then the trust can terminate and our leasehold interest will terminate. And in both of these cases, those trusts have fully terminated and the leasehold interests have terminated. I just wanted to point out these two charts on the last page. With the WMATA financing, WMATA had sufficient monies in a surcharge reserve account, and they simply transferred cash to the MDTA. We irrevocably deposited that in an escrow account with the trustee bank and then bought treasury securities. And so if you look at the top left portion of that first chart, it says escrow debt service. That's the remaining debt service on that financing up to the call date. So we had the regularly scheduled principal payment coming up in July, and then the following July of 22, all the bonds are callable. That's essentially the 10-year call date. So we would need approximately $17 million of principal and another $800,000 of interest to be covered from this escrow. So then we turned around and we bought treasury securities, and in the top right you can see the three securities and the maturities that we bought. And then in the bottom table you'll see the escrow account cash flows. So for the three treasury securities, we bought two T-bills, one that matured in July, one that matured in January of 22, and then we bought a treasury note that matured in July of 22. And so you can see in the first column that the T-bill will mature on July 1st, which is the same day that we need to pay debt service from that escrow. And I shouldn't say we, it's actually the trustee now that's fully responsible for that. So the treasury note will also pay interest on that date. And so the combined T-bill maturity and the treasury note coupon total about $2.169 million. And that's enough to cover the debt service from that escrow account of $2.168. And then the same thing happens in January. And then in July, the full $15 million is callable. And so the treasury note will mature, and that will be sufficient to cover the debt service on that date. The trustee has already issued a call notice to bondholders, and they've already issued a legal defeasance notice. So bondholders are made aware that those bonds are now legally defeased, and they're no longer backed by parking revenues. They're backed by the monies in this escrow account. So are there any questions about the two defeasances or any of the other non-recourse financings?
I just, and I should explain, but the 17 million is set aside so we can legally defease the bonds. Right, that's why it's in that account. You're on mute, I'm sorry. Alan, you're on mute.
I apologize. Thank you. Some of the other mechanics of the transaction were that you essentially need to cover the 17 million in principal plus the intervening interest between now and the first call date, which is July of 22. So that was another 800,000. So in theory, you need about 18 million to gross fund the escrow, but you can buy securities that generate interest themselves over the next approximately year and a half. So you don't quite need the full 18 million. So what happened with WMATA was that we already had money in a debt service reserve here. And so they only needed to wire us about $15 million. So the 15 million plus the money in the reserve was enough to buy the treasury securities for the legal defeasance. So that's what the 17.2 million in principal plus the 800,000 in interest, essentially less the interest that we will earn on the treasury securities, was enough to fund the escrow. And the bond counsel, we work with bond counsel and also the trustees counsel to verify that the securities in the escrow are sufficient to cover that debt service, and then they all declare that the bonds are legally defeased. So essentially, we have that approximately $18 million of securities sitting in that escrow account to pay off the bonds over the next approximately year and a half.
Thank you.
Thank you.
Are there any other questions? Okay, Alan, thank you for your report, and also Dana, thank you. And Jim, thank you for being here and for your comments as well. So we will move on to the next item on the agenda. Agenda number 4, third quarter budget comparison. Jeffrey Brown will present. Good morning, Jeff.
Good morning. For the record, my name is Jeffrey Brown. I'm the budget director of the MDTA, and I will be providing an update for our third quarter year-to-date performance against the budget. As of March 31st, we spent 64% of the budget versus a target of 73%. Some of the key issues and drivers to note is only Object 11, which is additional equipment, which is at 105%, and Object 13, which is fixed charges, which is at 98%, is above budget. All the other objects are below the target rate as of this point. The key drivers are seasonality, typically some heavier expenses occurring later in the year, some invoice timing of when they have come in, and of course COVID-19, which drives more telework, all electronic tolling, things of that nature, which has reduced our spend. However, would like to note that due to higher than expected spending and invoice lag in certain objects, that there is the potential to exceed the budget. It's projected to be an amount less than 5 million, but this would require a budget amendment. To get a little bit more detail, to mitigate our revenue loss from COVID and the movement to all electronic tolling and 3G transition delays, we did reduce the FY or full year 2021 budget, and this is inclusive of amendments, by 30.1 million. This may have been too aggressive for certain accounts. For example, Easy Pass Service Center, which is Object 0873. This was reduced for the anticipated CAPS TransCore savings, and the expected savings were expected to be earlier than has been realized at this point. Also, we have incurred some heavy snow expenses. We had some February storms, which drove some of our expenses upward. In addition, we have had incurred unplanned expenses, such as the COVID-19 response pay and related expenses associated with that, as well as reimbursables exceeding the budget. We do expect savings in other line items to offset the increase. However, there is the possibility that savings will not completely offset this increase. This would result in the need for an amendment in June. Our plan going forward is to continue to monitor the budget very closely and to minimize any exposure without incurring, if at all possible, any negative impacts to operations. In addition, we are working with the Secretary's office for the possibility of receiving federal funds through the American Rescue Plan Act. Moving into some of the specific objects on communications, which is object 3, we are at 29% spend, but this is almost entirely due to the state radio invoice, which we have not received yet, and that's worth $1.5 million. If we were to include that, we'd be at a 63% spend rate. Travel, object 4, is at a 5% spend. COVID-19 and typically some heavier spending in the later quarters, which is driving that down. Fuel and utilities, which is object 6, is at 51%. Again, COVID drives all electronic tolling. We have fewer toll collectors. There's more telework. All this is reducing some of the electricity spend. In addition, or moving on to vehicle operations and maintenance, which is object 7, we are at a 51% spend. COVID-19 has reduced the activity again, increased the work from home. There's been less gas and maintenance. Plus, we have moved to newer vehicles, so a lot of expenses are falling under warranty at this point. Moving on to contractual services, which is object 8, we're at 48% spend. Advertising is at 31%. This is due to the delay in 3G and typical summer campaign expenses, which occur later. We do expect this to come close back to budget. Engineers are at 807, which is at 48%. Again, COVID resulted in delays, and there is a lag in invoicing, and we do expect heavier spending towards the end of the year. So again, we do expect this to come back in line with budget. Training, 819, is at 55%. A lot of training has been canceled due to COVID, which is driving this expense lower. Social security services, 823, there's been less building usage due to less repair needs, less security locks and doors. Requests have been down, so that's driven that expense down. Fiscal services, 829, COVID reduced our traffic, and as well, the delay in NOTDs has reduced our credit card processing fees. Moving on to supplies and materials, which is object 9, we are at a 76% spend. Roadway maintenance materials is at 52%, and COVID's reducing the traffic, which limits our maintenance activity. We do expect this to come up to increase a little bit towards the end of the year. Salt, 906, is at 146%. As mentioned earlier, we had some February storms, and that's what drove this activity. And we do expect that there will be little or no activity going forward at this point. Easy Pass transponders, 905, is at 67%, and this is a result of working off inventory, which we will continue to do, and this was a reduced item in the amended budget. Replacement equipment, object 10, is at 54%. There is ordered equipment that's expected to hit at the end of the year, so again, this is probably going to come back close to budget ultimately. Additional equipment, object 11, this is the one at above budget at 105%. As mentioned, I think previously, we had some HR scanners that were expected to be expensed in full year 2020. They weren't received or paid until this year. Without this, we would be at a 52% spend. And finally, fixed objects is at object 13 is at 98%. This is one-time insurance expenses are starting to hit finally, and they have been a little bit higher than expected. So we do expect this to come back to be a little bit over budget. That concludes my presentation. I'll be happy to take any questions at this time.
Any questions? I just want to say I appreciate the update, and certainly the update of the difference there that you were talking about. This has been an unusual situation, a year for us, and I guess if we need to come back to the board, it's good that we have this discussion right now. If we have to get some approval. So, but we appreciate the update and the detail that you shared here from my point of view. Any other comments from any members? Okay. Jeff, thank you very much.
All right, thank you.
Member Von Paris, just
Yes.
one really fast thing, just to add. If in June we do need to come back for a budget amendment, when it comes to our policy levels, debt service coverage, this increase would barely move the needle. I mean, it's possible that our debt service coverage could change by 0.1, but it's also possible that it won't change at all. That sometimes this amount of a change could actually just be rounding when it comes to debt service coverage. So if we do come back, it's not putting us in jeopardy at all with regard to our financial policies.
Thank you, Deb, for that clarification. Okay. We will move on to the last item on the agenda, the third quarter budget comparison. And Jeannie Marriott is here to present. Good morning, Jeannie. How are you?
I'm good. How are you?
Fine, thank you.
I'm here to present an update on the status of the actual fiscal year 21 capital spending as compared to the fiscal year 21 budget in the fiscal year 21 to 26 draft CTP that was approved by the board in June of 2020. As of March 31st, 46% of the total fiscal year 21 budget was spent as compared to the targeted level of 75%. The total budget for fiscal year 21 is $543.3 million. Actual spending through March 31st was $252.1 million. 26 of the 105 projects budgeted in fiscal year 21 were within the acceptable spending limit of 50 to 100%, which is plus or minus 25% of the 75% target. And that leeway is due to normal lags in invoicing, which is usually about 2 months. 7 projects were budgeted for more than $10 million each in fiscal year 21. And if we look at attachment A, we see that the total budget on those 7 projects for fiscal year 21 was $333.7 million. And as of March 31st, $151.4 million had been spent, which puts the spend rate at those 7 projects at 45%. And even though we're just a little under halfway in the spending at 3/4 of the year, we do expect to spend about 95% of the fiscal year 21 budget by the end of the fiscal year. And does anyone have any questions?
Okay. No questions? We will move on. Jeannie, thank you very much.
You're welcome.
And that pretty much concludes our meeting today. And I want to thank everyone who presented and thank the board members for their service to this committee and all those who attended today. So there are no other items on the agenda, and that brings us to a vote to adjourn. Is there a motion?
Member Ardinger, I so move.
Okay,
Second.
thank you. Second by Member Carroll. All those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you very much. We stand adjourned.